Welcome to the HC Insider Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. Today, to start the new year, we're talking the oil markets. What were the key trends and developments in 2023, and what can we look forward to in 2024? Our guest is David Wech. David's had a 20-year career in economics in the oil markets. He's the chief economist of Vortexa, the ship tracking and data analytics company. As always, you can really support the show by leaving us a positive review, ideally a written review on the platform you're listening on. It really helps expand our audience and therefore continue to allow us to get great guests on. And as always, I hope you enjoy the episode and Happy New Year. David, welcome to the show.
Welcome. It's a big pleasure for me.
So we're starting the new year with a review of the oil markets in 2023 and what we think might be some of the key events or gates to look out for in 2024. So let's dig into the here and now. I guess if you look back over the last year, there's been a lot of volatility in the predictions alone, right, about where oil would end up at the end of the year, with quite a significant cohort talking about $100 a barrel. Including obviously some of the discussions that we've had prior to this as well. Yet, as we stand today, and we're recording this the middle part of December, prices are in the 70s. Can you just give us some sense of kind of, what's happened there and where we are?
I think what has really happened over the last couple of months, maybe already pretty much over the second half of 2023, is a dramatic slowdown in oil demand momentum. And I think that has catched a significant part of the market by surprise. Perhaps we can talk later on a little bit more in detail, but it really looks like the quite relevant pockets of the market. We see an outright decline basically on a year-on-year basis, and not even just a slowdown in the growth momentum. And I think in this context, what is simply very important is that the oil industry is an industry that is operating very close to edge, to capacity basically. So the way from a market where everybody is wondering how the marginal demand can be met and how the refining industry and the upstream industry is able to do that, to a situation where there is a bit too much supply in the market, and that is then really weighing on prices, that is a very short distance, so to say.
So it is very finely balanced. Before we move on, because I guess numbers are going to be important here, what is that current fine balance in terms of global demand and consumption?
Yeah, I think we are generally moving, or what is really changing in the market over the last couple of years is that there is much more data available. It's basically companies like Vortexa. We are tracking basically every single vessel at sea, so we can see pretty closely the entire picture, and we can add up these volumes essentially in real time. So in comparison, when I started in the industry more than 20 years ago, it was really, a big level of uncertainty of how much supply is coming to the market, how much is OPEC producing, where is demand standing. We were basically type of waiting for annual figures to get the complete global picture, and that included a lot of estimates. But now we are basically seeing how much oil is reaching the market. We have data from more than 110 countries globally that track basically again in real time the inventories of crude oil. And we have seen in 2023 that basically the oil price developments and the market structure, where the market is in backwardation or contango, these tended to behave very closely in line with how much oil was at sea, how much oil was being delivered, how much oil was going into or coming out of storage.
And I guess I'd like to end up on talking about that, because that's kind of an interesting dynamic, the granularity now in terms of data that's available to the oil markets and how that impacts the ability to trade it. But we'll come back to that. So let's talk about that strong signs of kind of slowing demand. Can you dig into where and how that's manifesting, and then tie it back into perhaps a broader picture of whether that presages a recession or whatever it might be in 2024?
Yeah. Again, what we are doing at Vortexa is we look at the global seaborne flows. So what we can see, for example, is that these flows of crude and refined products, they have never fully recovered to 2019 levels. It looked like late 22, early 23 that this point would be just about to be reached, where we are back to 2019 levels. But then basically the development went back southwards, especially if you include the very light components like LPG, which are steadily seeing increasing exports out of the US based on the still going on shale boom. So that's basically, I think, a pretty important observation that actually volumes transported at sea have been declining most of the time throughout 2023. We also do some metrics where we look at the 100 biggest import ports for key products like gasoline and diesel. And we define an import port as a port where at least 90% of the flows imports, so in order to exclude trading hubs like Rotterdam or Houston. And the idea is that this will give a pretty close idea of how the latest basically consumption figures, sales figures in the port hinterland are doing. And again, if we look at both gasoline and diesel and the second half of 2023, figures have actually been lower on a year-on-year basis than in the second half of 2022, and the growth momentum has slowed down also drastically versus the first half of the year. So these are a couple of key indicators that demand can't be doing that well. I think there are probably two main factors here at play. One is basically that this period of the COVID recovery is now essentially really over. We have seen very strong travel demand in the summer last year, but that was basically, so to say, the last revenge after the COVID period. People really wanted to travel a lot, but basically, yeah. So we have now maxed out this type of recovery trend, and of course, the world economy is in a difficult situation. We have massive inflationary pressures in most parts of the world. We have, I think, can be said de facto, a manufacturing recession. When manufacturing data is very bad in Europe, is not looking good in the US, is looking pretty poor as well as in China. So I think in that part of the global economy, things are not looking too good. And I think basically, yeah, if you want, the global economy as such is still struggling with the effects of 2 years of very high inflation level.
Yeah, and high interest rates, as we've covered. Let's just spend a moment on China because, the FT conference back in the Financial Times Commodities Summit back in March, a lot of predictions hinged on China's recovery coming out of COVID lockdown. That doesn't seem to really have materialized, struggling with low consumer demand, overspending on infrastructure and the hangover from that, the debt crisis there. What's going on with crude imports and product exports from their petchem sector in China?
Yeah, the recovery depends a little bit on how you look at it. There has definitely been a massive recovery, especially if you look at the second quarter of 2023 versus the second quarter of 2022, which was the key COVID period in China. But the problem is that ever since then, the momentum has really stalled entirely. So crude imports are trending lower for about 4 or 5 months. There have been very high petchem imports, petchem related product imports across the middle of the years, but this is also trending lower now. There is a huge amount of structural issues basically with the Chinese economy. The Chinese population is steadily aging. It's actually shrinking. Nevertheless, you have a massive amount of youth unemployment. Of course, China is highly dependent on the global economic performance, being such a big export market. And there are challenges basically left and right. Ultimately, all the geopolitical challenges are also not, so to say, helpful for the Chinese big factory, so to say. And in the petchem industry in particular, we have also simply a situation that there is a massive overinvestment in capacity going on. So that has temporarily pushed imports of feedstocks higher. But now basically players are realizing that there is far too much capacity. In line with that, margins are coming under pressure, and then the one or the other players have to reduce operation rates, and then with that, basically the entire dynamics in trade is also coming down. What is probably particularly striking at this point in time as well is that we have now in China, but also in Europe, an observation where crude inventories have been drawing for many months and are generally at pretty low levels. Nevertheless, crude imports are also coming down. And even with the lower prices we have recently seen and the much lower spot differentials and so on, there is no sign so far that there is comeback demand. So basically, refiners and buyers, they stay on the sideline even though prices compared to where they have ever been earlier in 2023, they are not showing interest. So basically, that is giving a strong indications that these refiners are seeing really poor demand figures, and with that also pretty confident that there is not much upside to oil prices at this point of time, because otherwise they would make use of this lower prices. That's, I think, a signal to look for an inflection point as well as on a side comment.
Interesting. Just one question before we move on. You spoke about lower seaborne volumes. How much is this data impacted, or this insight impacted, by the dark fleet? Russian oil, other sanctioned oil moving around that we just don't have any visibility in because the ships have turned their transponders on or whatever it might
Yeah.
be.
Yeah, that's a very good question. I think the impact of that is not basically on the data quality in terms of levels over time. It's on the data quality in terms of how up to date it is. So basically, to give you an example, if Iranians, for example, are trying everything to hide their exports, that is making our life much more difficult, but we have very good sources to tell us when the Iranian volumes are arriving in China. So basically, at that point of time, we can sometimes only at that point of time, we can basically back construct what has happened before. A quick word on the much more relevant flows in terms of volumes from Russia. There is only, the signals are only occasionally turned off. They are not consistently turned off. So we may have to infer when and where the vessel has been loading, for example, but it's not that we are not able to track it all together. So these factors are making our life a little bit more difficult and a little bit more, how to say, if you want, also interesting occasionally, but they are not hindering to grasp, I don't know, the 99.8 or whatever percent of the volumes. Yeah? It's maybe only the occasional cargo here and there that stays dark. And then again, I said, whether it stays dark for its entire voyage time for good, I would already doubt that.
Yeah, interesting. Okay, well, so that's a relatively sort of somber picture on the demand side. Tide, we haven't obviously mentioned greenhouse gas emission goals and sustainability goals. This seems to be much more of a shorter-term economic impact. And you actually talk about that in terms of the supply side, and that cross-border energy trade is 99% of, or oil is 99% of that, or hydrocarbons are, versus electricity. So we're not seeing that impact yet. So we're very much sort of talking in the short term here. But let's turn to that. Let's turn to the supply side. What is going on there? Are we seeing investment driven by those higher expectations last year and so forth? Where's the supply side?
Yeah, I think it's good here to differentiate between, so to say, certain specific short-term developments or current developments. So one aspect that is interesting to note is that we see loads of supply out of the Americas. It's predominantly the US, but not only the US. There are countries like Brazil, Guyana is a big newcomer in the market. Canada is also seeing growing exports. If we take just the US alone has imported an equivalent of 500 million tons per annum of seaborne oil and gas, both in October and November. It's the first time ever that these levels have been reached 2 years in a row, 2 months in a row, I'm sorry. And first of all, that's an easy forecast for this year. Basically, there will more will come out of the US again, particularly on the light hand side, LNG, LPG again, but also crude to a certain extent. And just to put this into context, this level is 3 times higher as we have seen in 2016. So just within 7 years, basically, there has been a tripling of those volumes. But I've mentioned Guyana as one of the new producers out there, and it may very well be the last big additional supplier to the market. And there is definitely an issue that investment in the industry is not going too well. And what is often overlooked is people, like to look at the latest US data, which is most of the time growing. It's an interesting thing to follow the startup of production in Guyana. But what is very often a little bit overlooked is the natural decline. So basically the steady shrinking of supply if you're not constantly investing. An interesting observation, for example, is within the OPEC group. I would argue that within this OPEC plus group, there is really only two countries that have probably spare capacity. It's Saudi Arabia and UAE. And when after the COVID period, they rapidly and steadily increased their production quotas, already in late 2021, exports of the group started to stagnate. For a full further year, the quotas were increased and increased and increased, but the volumes did not increase. And that was just showing that all these countries had very quickly basically come back to the maximum capacity, and that has been already significantly lower than in 2019. So basically this COVID period had a significant impact. European crude exports are declining for the last 4 or 5 months in a row, and that's in spite of this new addition of this big Johan Sverdrup field in Norway. So natural decline is a big factor, and I think that's basically we are already entering, I think, in a new phase of the industry where I would tend to say that it doesn't really matter that much actually whether oil demand is growing at the margin or declining. It's really that the point is that the starting position is so massive. So hydrocarbons are still accounting for 83% of the primary energy supply. So that's coal, oil, and gas. And even if we reduce that, which we didn't really manage to reduce actually a lot over the last couple of years, but even if we reduce it and if we assume that world oil demand, and that is far against any forecast, but if we were to assume for a moment that it were to decline from 100 million barrels per day today, or a little bit more than that, to 80 million barrels per day in 20 years' time, we would still need a lot of investment in the industry because we need to replace production. You need to add refining capacity because some refining capacity is constantly dropping out of the global pool. You need to add oil tankers. Oil tankers usually with about 20 years are normally reaching the end of their lifetime, but we see more and more oil tankers staying out there for longer simply because no new tankers are coming into the market. So I think the lack of investment is a problem all across the industry, basically, whether it's upstream or whether it's in refining or in oil tankers, it's coming in all these factors.
We're going to come on to sort of the aging fleet in general, particularly refiners and the tanker piece. Part of the argument that has been made by Jeff Curry on this podcast, and indeed why we had Edward Chancellor on early last year, when this goes out, is that low interest rates, lots of money into financial engineering, lots of money into the unicorns, lots of money into what they would term pie in the sky projects. And the argument was, as interest rates rose, we would start to see capital go back to the oil and gas sector where the returns are greater and would come much earlier. Are we seeing any shift in that, or is investment, is capital still staying away from the sector?
Yeah, I'm not the perfect expert on this, to be honest, but my impression is that there is a strong level of hesitation, and that's simply linked to the fact that a lot of investments in the oil industry are for very long amortization periods. So basically, if you build a refinery, you need 5 to 10 years to build it, to plan it and to build it. And then you need to run it at the very least 20 to 30 years. That basically means you need to plan 40 years into the future. And who wants to make a bet on oil demand in 40 years' time? For an oil tanker, perhaps not as long, but you need to plan with about 25 years. And with upstream industry, it may be a little bit quicker by now. I mean, that's also the beauty basically of the shale industry, because there you can, we have a much shorter investment horizon. You basically can take a decision today and can already drill perhaps more, produce more in 6 to 9 months, 12 months, something like this. So you have a very quick type of return. But the conventional big upstream projects, offshore and so on, there is still, a planning horizon of 15 to 20 years time.
Yeah, which could have dramatic impacts in the next 5-10 years, as you say, when really we don't see that big shelving of oil demand. Okay, let's return to the refining margins and aging refining fleet. What's that picture look like in 2023, and what can we expect in 24?
Yeah, 23 was definitely a very interesting year for the refining industry, and I think it was pretty reflective of what's going on in the oil market overall. So we really had basically concerns about available capacity, especially in the middle of the year. We had started the year with very high refining margins because there was the big question of how the loss basically of Russian diesel supplies and other product supplies to the European market could be handled. So refining margins have been very strong in the first half of the year. Then we had very strong summer demand, travel demand, as I mentioned earlier on. And at the same time, we had a lot of refinery outages. So generally, I mean, the summer seasonality in the refining industry has been there forever, but I think it will be even a stronger factor in the future because I think that oil demand will get even more seasonal. The demand of heating oil and oil for the winter months is generally losing relevance, and it's really basically the road and air travel is playing a big role. And in line with what we have also seen, the refining fleet, especially in Europe, North America, is getting older and older, and we have more and more of these extreme weather events, very high temperatures. In line with that, we had a very high level of outages in the spring and summer period, and that for a certain period of time, it really looked like that the market would struggle to meet all the demand. But then we had, I would call it a pretty dramatic turn of events type of in autumn, because this very strong margins in the summer months has led to very high product supplies hitting the market late summer, August, September. And then it looked like that the refining maintenance period would take out a lot of supply and would tighten the market even further. There was a strong maintenance period in the Middle East and in India, but the reality was the market did easily cope with that situation. And that was basically to a large extent due to this substantial weakening in demand momentum. And to the last couple of months and last year have simply been very well supplied. And that's the case even for some of this new refining capacity that was starting up over the last year, did start up only relatively slowly and will still have knock-on effects this year. So some of this capacity, for example, the 600,000 barrels per day capacity in Al Zour in Kuwait will only probably, if it works well, will only fully run in 2024, even for the start that was going on throughout pretty much the entire last year.
Yeah, sorry, can you unpick that a little bit for us? So you've got an aging refining fleet in the West. You've got these new mega refineries coming on in the Middle East. You know, will sort of potential shutdowns in the former be offset by the latter? I mean, or is it quite a confused picture?
Yeah, I mean, overall, it generally looks like that all the capacity that is in the making, and there are basically 3 refineries in the Middle East that are still in the startup phase. There is one refinery in Nigeria scheduled to come on stream relatively soon. We will see how smoothly that goes. And then there's a refinery in Mexico. And that's pretty much it for this year. So that's not necessarily a huge amount of capacity. If, for example, the OPEC forecasts of demand growth in 2024 of about 2.3 million barrels per day are anywhere close to true, that's very limited additional capacity. So if you believe this type of figures, then we can very quickly basically come again into a period where the refining industry is actually struggling to meet demand. But of course, it's also possible, as type of alluded before, that if demand is disappointing and refineries are running relatively healthily and without too many outages, then we have too much supply. And if this over relative healthy supply periods are going on for longer and refining margins are under pressure for longer, you will relatively quickly have new refining shutdowns popping up. I would argue that there are at least something like 30 refineries in Europe and probably something like 20 refineries in the US where the owners have more or less concrete plan to shut them down this decade. Or within the next 10 years. And the decision whether to shut them down and when to shut them down will simply be always a question of how the market is looking like, as well as the next maintenance cycle. Refineries have typically a 4 to 5 year maintenance cycle where you need to do a full, deep work, revamped work, which costs you millions of dollars. And this decision whether to do this full next cycle or not will, often be linked with the question of whether the overall operations will continue. So basically, I think this is a type of mechanism that is in place now that will make sure that the refining industry will pretty much most of the time make relative decent earnings, especially compared to the long history of the industry, simply because the spare capacity will always be pretty limited, except for short periods of slowdowns. But then you will have shutdowns coming in relatively quickly, as we have seen also in the COVID period. So refinery margins have only been really weak for about a year's time, and then basically all the shutdowns have taken out the slack of the system and have led to a healthy recovery in refining margins.
The HC Insider podcast is brought to you by HC Group, a retained search, intelligence and advisory firm focused solely on the global energy and commodity sector. With 6 locations across Asia, Europe and the Americas, and over 50 consultants. To find out more, go to our website, hcgroup.global. There, you can also sign up for our HC Insider content for more interviews and white papers on relevant trends and talent impacts in the commodities world.
It's interesting because it also points to some of the volatility.
Exactly.
Right? You've got the shocks of unplanned shutdowns. You've kind of got this interesting setup of game theory at the boardroom level about who jumps first on closing down with that maintenance schedule. And it all points to the trend that we've seen accelerate in 2023, which is all of these refiners globally and producers as well, the majors, are all trying to build trading capabilities to manage that volatility, capture margin, and actually inform these longer range strategies, right? So it all ties in together with this concept that we've been really talking about in 2023, which is volatility, which brings me on to, I guess, the oil trading part. And it's been extraordinary, really, when you sort of step back, that 2023 is another year like 2022, and really since COVID, where the trading world, sometimes much maligned in the press, has been crucial and instrumental in enabling these markets to actually function and managing these risks, right? We haven't seen kind of the big energy security issues arise, despite some of this background volatility that we've been seeing. Can you talk to that a little?
Yeah, I think it has been amazing once again to see how responsive the market is, and that's ultimately the business of the traders, to make sure that all the available barrels are supplied to where they are needed under a set of conditions. And the conditions have changed with sanctions on Russia. But under these conditions, the market has been extremely quick to reallocate these barrels properly. And just to follow up this 1% figure you have mentioned before, it is, I think, an amazing statistic that 99% of the global cross-border energy trade is happening in hydrocarbons, and the huge majority of that is actually happening in oil. So that is pointing to the virtue of oil, that it is easily traded everywhere. Every country has import and export infrastructure. You can send around vessels all around the globe, so you can meet any shortfall that is happening wherever it is pretty quickly, within days or weeks. And in my 2 decades of observing the industry, I've seen this so often. It doesn't matter whether it's hurricane outages or some other or some strikes or whatever may happen around the world. There is a very swift readjustment basically of flows at sea, and a new equilibrium is found very, very quickly. And last year, I think one of the key observations, and honestly, I've been wondering a little bit myself, was basically this question about the Russian diesel supply to the European market. And in retrospect, it was so easy for the market to cope. We have seen basically, first of all, a significant increase in the intra-European diesel flows that included to a certain extent also Turkey. So Turkey has started to import a lot of Russian diesel. That has freed up their own domestically produced diesel for the European markets. We have seen stronger supplies from the Middle East and India to the European market, and to a certain extent also from the US. From a global shipping perspective, these are all relative nearby markets. So it's not necessarily a strong addition to the shipping cost, so to say, in that regard. For the other side, for the Russians, it was partly way more difficult to find the alternative outlets, which have often been much further afield. But then again, new players were popping up in the Middle East, in India, in China, and took care of the logistics and as well of basically of the placement of these barrels.
Okay, so I guess moving on to we're doing this. I mean, it's a fantastic sweep of the oil markets in 23, and we'll come on a bit more to what next year might look like. But the other big story, obviously, is on the oil tanker side, where we had these extraordinary rates post-COVID. What's been happening there?
Yeah, it's a very interesting market, and freight rates have been very healthy. I still remember very well an industry conference. I've been in November in New York on the shipping industry, and I have never seen before such a bullish and happy crowd. They were basically all smiling, making a lot of earnings. And that is particularly interesting when you remember what I said before, that the actual volumes of oil at sea have actually been not rising below 2019 level, and over the course of last year actually been declining. So how is this possible? It's possible via much longer voyage distances. So on average barrel basically was just going much longer, and that is binding a lot of tanker capacity, and that is happening across the board. It's happening for crude. Interestingly enough, basically the OPEC cuts in the Middle East, especially Saudi Arabia, they are actually type of positive for the tanker industry, because it basically means that Asian refiners need to buy instead American crude, and that is going, so to say, much longer distances. Then, on the product side, you had basically the rerouting of Russian barrels. On more the gas side, you have all these light ends from the Americas reaching generally the East Asian market, which is a very long distance market. What comes then on top of that is, issues with these choke points. The Panama Canal has led to much less transit through that area, and that is basically redrawing the global map. You have somehow to imagine that this means that, for example, for the west coast of Central and North America, it's not anymore the Gulf Coast that is the closest, but it's with one big bang type of South Korea and China, who are the closest suppliers to that region. So that makes is having huge repercussions, and it's again adding to this ton-mile demand in the tanker industry. Of course, all the geopolitical uncertainties, the sanctions, the separation of a tier one fleet from this gray dark fleet we talked about before, all these factors, all this uncertainty in the Middle East, and the even bombings of tankers and so on in offshore Yemen, all these factors are adding premiums to the market, basically left and right. And on top of that, there is this other factor I already mentioned before. There is a very limited supply of fresh tankers, oil tankers. There is quite some addition of new vessels for LNG and LPG. But for crude oil and core refined products, very short order books, basically, or new vessels coming into the market for a couple of years now and into the future. So that is tightening the vessel supply side and contributing to a reasonably healthy outlook.
And there is growing recognition, and I think it could be one of those events in 2024 that suddenly splashes across the world news. There is a major environmental disaster with this dark fleet that obviously has brand new captains, aging vessels, new routes. I mean, it's a bit of a recipe for disaster. One note you also put in our notes to discuss this was a drought in the Panama Canal. Can you just help us understand that? That sounds like it could be quite an impacting event.
Yeah, so basically the Panama Canal is a crucial transit route from the east coast to the west coast of the Americas, and it relies basically on water to fill these canals basically, and it relies on rain and on lakes in that area, and the weather has been very dry for a long period of time, and they are simply lacking the water basically to maintain these operations, and that means that the amount of vessels that can pass through is being drastically reduced, and there is a certain order of priority which vessels you send through, and the oil tankers are generally coming pretty much at the end of this list. So that means you're not anymore easily able to send gasoline or diesel through the Panama Canal to the American west coast, and that means that you would either have to go all the way across America, or basically it becomes more profitable for Asian refiners to supply the west coast of the American market.
Interesting, because a lot of development in the Gulf Coast has been predicated on that Panama Canal expansion, right? So,
There's a couple of challenges, by the way, for Gulf Coast refiners coming up. I think for this year, we have on the one hand, clearly disappointing demand trends within the US. So that means that the margin more would have to be exported. We have the Panama Canal issue. We have new refining capacity potentially starting up in Nigeria, potentially in Mexico. I'm more skeptical about it. But also the basically Middle Eastern refined products are entering the Atlantic Basin market. So this is a couple of factors that will challenge US Gulf Coast refiners and will be interesting to see how this plays out. It cannot be completely excluded that there could also be the one other refining shutdown in the US in 2024, and the same goes for Europe as well.
interesting. Right. Well, let's move on to geopolitics and let's talk OPEC. That's obviously been in the news a lot this year. Where are we ending the year with OPEC, and what are sort of the internal intricacies there?
Yeah, it has been a very intriguing, interesting year actually from an OPEC perspective, and it's very clear that I would say Saudi Arabia has called the shots, and I think has also been very successful ultimately in changing a couple of baselines. So while it is true that Saudi Arabia has carried the load very clearly in terms of cuts last year, they have arranged within the product group new baselines, and we have basically a type of fresh start in 2024. Production targets for all countries have been adjusted, and they are now basically reflecting the current production capacities. That has been a big pain for OPEC for a long period of time, that the production targets were completely misaligned with the actual production capacities of various countries. What that means, in other words, is that if the demand situation deteriorates further, you can be certain that Saudi Arabia will ask in a much more, firm way all the other member countries of the group to contribute to any cutting efforts. And I think that's some of the things that will be interesting to see. We have already seen basically certain developments on the Russian side. I would say in a nutshell, Russia has told the market and the OPEC Plus group a lot about cuts in 2023. I'm personally not convinced a lot of that has materialized. At least we have not seen a significant decline in exports out of Russia of crude and products. Most of the time, these exports have behaved very close to seasonality, and with all the Russian budget needs, I would also not be surprised if they tried most of the time to make the most money by talking up the market in terms of prices and sending out as much volumes as possible. But they have provided a very clear mechanism for the cuts in the first quarter, so it is actually to be measured on exports versus the May-June baseline in 2022, and this target level for the exports is very low from a seasonal perspective. So it will be interesting to see whether they will comply with that or not. Overall, I think the situation is clearly such that this group will have to continue to manage the market. And the crucial question is basically to what extent Saudi Arabia is willing to do it alone, or to what extent it will type of force the other players to come in as well.
I guess staying on geopolitics, thanks for that. Staying on geopolitics, the US and sort of the two elements here. One is it kind of, despite lots of protestations on Twitter throughout the year, or X, it turns out they might be one of the best traders out there with the SPR. And, obviously their sanctions policy towards Iran, Russia, Venezuela. You mentioned Guyana earlier on. Venezuela and Guyana potentially we have a flashpoint there. What's sort of been the US picture for 23, and how might that continue into 2024?
Yeah, I think the US authorities are particularly well aware of all the limitations in terms of capacity and supply in the industry. And that is also how they have designed all type of sanctions. There is a lot of discussion on this Russian price cap, which is still often misunderstood. There is nothing in the related sanctions from the US that hinders, for example, China or India to buy Russian oil at any price, as long as they're not using Western services. If they want to use Western services, then they have to adhere to the price cap. So what I want to say is that basically the intention here is very evidently to keep the barrels in the market. but just try to penalize the sellers, so to say, via increasing the logistical costs. Yeah, and I think to a certain extent that has worked. I think Russia is typically getting a couple of dollars or $10 per barrel, whatever, less than they would get in another environment. And at the same time, the oil has stayed in the market, and I think that's still the case. I mean, it's even if more recently the market has looked much looser, it is as we are in a market where inventory levels are very low from an historical perspective, especially for crude oil, and essentially. Losing one player like Libya or also Iran completely, because Iranian exports have gone up quite significantly over the course of 23, especially in the first half of the year. Then the market can run very quickly short again.
And this is obviously, there is a wider escalation of conflict in the Levant as a result of what's going on in Israel that could have a significant impact. Can you just, I guess, sort of staying on that theme a little, it is always, and it always is, a complex picture. What is kind of the everything normal scenario where, what does that mean for oil prices? And I know it's always unfair to ask this of an economist, but I'm going to anyway. It's sort of the roughly speaking, everything continues as is. Do we see a steady, slow trend downwards or stabilizing in the 70s? And then what are kind of the one or two shocks, we've noted a couple of them here, that you think could really change the outlook to the upside? Strange term, but prices rapidly going higher. What are kind of some of the shocks that people need to look out for that could happen?
Let's start with the normal scenario. I mean, it's in the oil industry. It's really a bit of a funny question. What is the normal situation? I would say, I mean, generally, we have seen last year, and I think the chances are very high we will continue to see that there is basically an OPEC plus group which is willing to cap the downside. Yeah, and if necessary, that is being done by reducing the supply to the market. I would also like to mention on a side note here that this is, I think, ultimately something pretty much everybody in the market is type of interested in. Yeah, so that includes the US, where the shale industry is dependent on a reasonable oil price. It includes Europe, which wants to shift away from oil to other energy sources. That is only possible if oil is reasonably expensive. And it includes the Chinese market, who, linked to the European efforts, want to be the big player in electric mobility. Again, this will not work if oil is ridiculously cheap. So basically, I think ultimately everybody wants to have some stability and some minimum level that is able that allows to basically plan all type of investments. The question is basically to what extent OPEC can really cap the upside. And that is, the other thing that doesn't get a lot of appreciation, but Saudi Arabia and the UAE, and as I said, I think it's the only two countries really, they have a significant amount of spare capacity. So they're all the time willing to have this capacity available to come in, but it is surely limited. Yeah, I guess personally it will be somewhere between 1 to 2 million barrels per day. So basically the shock can pull prices much higher. Yeah, evidently comes from the supply side. Unfortunately, there are so many scenarios you can build in today's world. Yeah, you can talk about the Strait of Hormuz and Iran doing something there. You can talk about Yemen and the area over there. There could be a bigger, accident in the Suez Canal or somewhere else. You have mentioned Venezuela, which has become a concern as well. Of course, war with Ukraine is still going on, and Russia is still being sanctioned and subject to all type of political pressures. And of course, it cannot be completely excluded that at one point of time, Russia decides to stop exports partially or to block just exports from Kazakhstan via Russian territory and Russian ports. So ultimately, I think the big risks on the supply side, if you're interested in the upside to prices, of course, you could make the argument that if all these economic concerns go away and oil demand were to boom next year, then this could also be a driver. But I personally don't see that. I think that generally how to say, it's ultimately flexible oil demand that is to a certain extent also modulating or steering prices. The point is, and we have seen this also again last year, if prices reach $100 or past the $100 area, then you have a very swift, basically, reaction on the consumer side, because ultimately it's a lot of individuals around the world who are then driving a little bit less, perhaps they're doing the one or other air trip less, and that in accumulation does have an impact. Stocks are being drawn down and so on. At the same time, if oil is getting cheaper, you can immediately see in the US that there is more driving going on. People are getting easier with the spending. So there is a certain level of demand side sensitivity, which is leading to it also, apart from OPEC, to some type of auto correction in the price range. So I personally would say any sustained move out of a window from $70 to $100 per barrel is not particularly likely for next year.
Yeah, but if it does, it's probably supply driven rather than anything else.
Yes.
Interesting. Okay, so coming full circle, I mentioned this at the start. It is fascinating that, as you started out by saying, the granularity of data and obviously converting that data into information is so much more than it was when you started your career, and seems to advance every year, with obviously the growth of Vortexa, and we can put a link to your company in the show notes. Is that and this is sort of going a little bit off topic, but to finish it up, is that sort of a net positive for the merchants and the traders? Is this who presumably, with all of these potential shocks and disruptions, that's where they really come into their own, and that's why, for the most part, you have these sort of 2 or 3 big moves a year, which trading houses and so forth can capitalize on. But that must have a profound impact on, I guess, the ability of refiners and these majors to actually accurately hedge, and also, but on the kind of the opportunity out there for the traders, who typically that data was very much proprietary and was delivered by their asset base that they spent 15 years building.
Yeah, it's a very interesting question. I would tend to say that for the big trading houses, all this data availability is not necessarily helpful, because in the past, they may have seen 1/3 of the market directly, and that may have been good enough to call the shots, while everybody else wasn't seeing anything. It was just a black box. In today's world, basically type of one-man shows somewhere with access to our data and many other data sources can perfectly call potentially the oil market. I found it generally pretty interesting that this sell-off we have seen in Q3 last year was actually first driven by the futures market, and only afterwards it was basically showing up in crude differentials, in market structure. Refining margins is a bit of a mixed picture, but usually I would tend to say it's the other way around. So what I want to say is that basically this sell-off was more driven from a big picture perspective, and not necessarily so much from basically the on the ground reality, at least not in the crude market.
Yeah, interesting, and that's kind of a trend that we've been covering over the last couple of years, notably with Greg Newman as well, and some other oil traders. Well, David, it's been a fantastic discussion. I've really enjoyed it. I look forward to having you back on this time next year, and we'll see where we stand. But I think you've really framed up last year and this year for us from a perspective of the oil markets.
Yeah, many thanks for having me. It was a big pleasure for me as well.
Thank you for listening. If you enjoyed this episode and want to support the show, please give us a positive review on Apple Podcasts or Spotify.
To find out more about HC Insider and HC Group, a search and advisory firm dedicated to the commodity markets, visit our website at www.hcgroup.global. There you can find out more about our services and our offices around the world. There you can also find more content, from interviews to insight pieces to more podcasts focused on the commodity value chains. Thanks again for listening.